The purpose of the Global CFO Council is to provide an educational and networking forum for senior financial executives in order to share best practices, discuss current financial issues, and to learn about current topics related to the performance of their jobs.
Hey Dawson, how are you doing, sir?
Good morning. Doing well. Thanks for asking. Hopefully everybody else is doing well on this Wednesday. It is Wednesday, right? Seems like Groundhog Day ever since March of last year. But
It's so crazy. It's something you have to actually check nowadays. I feel like I need to check the calendar. I have no idea if it's actually Wednesday, Tuesday, Thursday.
very true. Very true. But I'm good. Thanks for asking, Robert.
Yeah. Well, thanks for being here. Dawson, can you see the screen?
I can see the screen.
Yay. I am projecting your presentation, and I'm going to get into some introductions, and then we'll start the presentation. First of all, everybody's been muted upon entry. Stay muted. If you have any questions, we love them. We love questions. Use the chat box, and I will pull questions out of the chat box during some pre-scheduled stopping points and hit the speakers up with some questions. As always, please like, comment, and share my content on LinkedIn about this presentation. And you could be the Spread the Word winner. Last month, Joe Moore, the Vice President of ScanSource, is our Spread the Word winner. He will get an amazing box of swag. What's in that box? I have no idea, but it will be awesome as a thank you for spreading the word. And you too could be a winner. As always, the Educational Foundation for Women in Accounting, or the EFWA, is our charity partner, and scholarship period is open, I just heard. So if you are a woman or know a woman pursuing an undergraduate, graduate, or PhD in accounting, they are accepting applications for their scholarships. We've given almost $100,000 over the past few years to that charity. What is the CFO Council? So we're an educational and networking forum, both virtual and physical breakfast meetings. We're going to kick back off, fingers crossed, the physical breakfast meetings where we have chapters later this year. Once I'm hoping the pandemic will be muted because of the vaccines that are out. So that's what I'm hoping for. And as I said, stay muted, and we'll take Q&A via the chat box. Dawson, can you can still hear me?
I can.
All right, Dawson. So one of my little favorite shticks is that I don't actually read the bios. You sent me your bio, which I really appreciate, but I don't read the bios. I just search the internet and I try to find information on our speakers. And we've got two this time. We got Dawson, and we also have Stacy. And I'm going to go over both of them here. And sometimes, Dawson, this stuff is true that I find, and sometimes it isn't. So
I love it. That's great.
it is, and it's Furco, right? Dawson Furco?
That's good. Yes, nice job.
Which is not how I was going to pronounce it until just a moment ago when you said how to pronounce your name. So I'm glad you did. Dawson is a partner and co-founder at CTA. Before that, an executive at a couple other tax credit consulting firms, and then a long career as an executive at IT and communications companies. Is that correct, sir?
That's correct. In a cliff note, yes.
And studied economics at the University of Minnesota.
Yeah, don't you know?
And I don't know how to pronounce this, but I think you went to Osseo Senior High School in Kansas City?
It would be Osseo.
Osseo. You're an
Actually, Osseo's in Minnesota, so just so you know, Osseo's in Minnesota. That's where I grew up.
Minnesota. Well, you got rid of the accent, so well done.
Yeah, usually after a couple scotches, it comes back.
And as it says here, you're an IRS enrolled agent. And something interesting I found out about you, and I'd show the picture, but
Oh, gosh.
I think you're into either Spartan races or just randomly running in the mud for no reason.
Yeah, that was, it's not the Tough Mudder. It was something called the Warrior Dash. I'm surprised. That's great. That was interesting.
And Stacy, I think Stacy, hilarious. She's probably not thinking this is funny. I think it's funny. I see her jumping on and off the call So she's probably having some sort of internet issues. But I'm going to introduce her, and then Dawson, while you're going, I'm going to work with her to make sure
Okay.
her connection's working. But Stacy Goodman is a director at CTA. Before that, worked at DHG, and then in the construction industry. Got her undergraduate in construction management at Georgia Southern. I don't know how their construction management program is, but I know when I went to college, they were the #1 party school in the United States of America. So I'm sure she had a very good time, and it's impressive that she graduated. Before that, she served her country in the U.S. Coast Guard as, from what I could find out, a diesel mechanic and a marine safety officer. So I think that's pretty cool. I think she served about 4 years. And super active in volunteer causes such as Canines for Service, Habitat for Humanity, which I think she's on the board for, and something really cool called Healing Waters Fly Fishing, which sounds awesome. And I don't know if this is true. She may or may not have been in theater at Marysville High School in Michigan, and I may or may not have found a picture of her in theater. So I don't know if that was actually her or not. We'll find out maybe when she gives her presentation later on. And for time, I won't share pictures of Dawson running through mud and of Stacy maybe being in a theater production in high school.
Thank you.
Well, Dawson, I pass the mic to you, sir, and I'll advance your slides as we go along.
Excellent. Let's go ahead and dive into this. And again, thanks for the introduction, Robert, and thanks for getting the pronunciation of the last name correct, although I probably would have addressed anything you came up with. So good morning, everybody, on this Wednesday morning. Before I get started, please understand, I do a copious amounts of broadcasts on this topic. This topic alone, we're going to talk about 3 today, but this topic alone, called the Research and Development or Research and Design Tax Credit, I can speak on this for an hour and a half. So just know if you'd like more of it, you can ask Robert. I'll get those things over to you. But I'm going to go through this in pretty quick order. So a really high-level overview of the credit. And then we're going to take the baton or bring the baton over to Stacy, and she's going to talk through these other 2 tax specialty arenas. So I think that's good on the agenda side. Okay, so in a nutshell, I'm sure you guys know the tax code is very simple. I say that facetiously. There's probably 9,000 code sections, 45, let's just make it easy, 4,500 on the personal, 4,500 on the commercial side, and we're going to dive down very deep, or we dive down very deep into Section 41, and it's called the Credit for Increasing Research-Related Activities. The one thing I want to highlight for everybody is this credit is agnostic to industry, has no bearing on what you do as far as services. It has no bearing on the outcome of the design and or research. So please understand that. This is applicable to any industry out there. It's not new. Although the name has never changed, what throws a lot of people off. You know, it evokes thoughts of white lab coats, petri dishes, and the scientific method. Yes, that is R&D, but it's a lot of it has changed, okay? So since 1981, when Reagan brought it in, it was always renewed at an 18 to 24-month period. So it was always extended as a temporary reg. In 2016, it was permanently codified, okay? And it is probably the most powerful tax incentive on the book today because it is a dollar-for-dollar tax credit for offsetting liability, okay? So orders of magnitude greater than the deduction, okay? The congressional intent, why it exists, is to reduce the high cost of U.S. innovation. Big word, right? But it's reducing high cost of U.S. wage because that's where the innovation happens, okay? It is I should say too, the congressional intent is, what the Treasury has found that for every dollar they provide in research-related activities or tax credits, about $1.30 comes back in the form of increased tax revenue to the Treasury. So it's a very powerful incentive. If you've never taken advantage of the credit, a couple things I will say too, is it's agnostic to the type of tax entity. As long as you're a federal taxpayer, that would be the only caveat. So if you're a nonprofit, fully owned ESOP, then there's not going to be some application for you. But if you've never taken advantage of the credit, you can actually reach back 3 years. It's a 4-year open statute look, okay? And it's primarily driven by annual wage expense. I think we're good on that slide. Okay, so if you're bored, bouts of insomnia, Okay, I'm going to direct you to IRC section, Internal Revenue Code section 41, and let's define R&D in Congress's terms, okay? Essentially what you're going to see, all it says is that R&D is the development of a new or improved business component, okay? Don't get wrapped around the axle on those two fancy words, business component. There are actually 6 within every 4 walls of a business, okay? These are the business components: products, what you make or sell; processes; software; techniques; formulas; and inventions. Okay, that's where you're going to find qualifying activity. And it goes on to further define that that activity, whether it's a process improvement, product, technique, formula, invention, will qualify, and the wage expenses tied to it will qualify if it passes what's called a 4-part test. So this is the statutory definition of R&D on steroids, these next few slides. So let's go ahead and jump into the next one, Robert. Okay, so the first test, we call it the permitted purpose, okay? And what it says is the taxpayer, whenever I say taxpayer, think about your W-2 expense, okay, your employees. The taxpayer needs to be attempting to do something new or improved to that business component's function, its performance, its reliability, or its quality, okay? It doesn't have to be all 4 of those. It's just that you're attempting to do something, and that is a key word. You're not doing these things for the fun of it, okay? Whether it's a new product or improvement to a product or improvement to a process, software, technique, formula, or invention, okay? It's about the attempt. And again, if you recall from the first slide, or when I first started, it's agnostic to the outcome, agnostic to whether you succeed and or whether there's a false start, okay? It's always about the attempt. So that's the first test. And one thing about the software, we're not talking about the capital or purchase expense of software. We're talking about if you, whether you subcontract it out or you internally develop code for the purposes of making your business better. This R&D credit is always about looking for ways to do what you do better, faster, stronger, cheaper, doing more with less, okay? That's kind of what you're looking for. So that's the first test, the permitted purpose, attempting to do something. Test 2. Okay, so test 2 is called the technical risk test or technical uncertainty test. And what it says is the taxpayer needs to be endeavoring to discover information that you did not know before you started the new improvement or process, technique, formula, software, technique, or I've already said technique, formula, or invention, okay? You're endeavoring to discover something you did not know. For example, let's say that you were an engineer and you had a team, let's say 6 people in an office, and someone was paying you to design a building facade, okay? They're going to explain to you what they'd like you to accomplish, and based on the facts and circumstances, those 4 or 5, half dozen people, based on their experiences, their knowledge, their know-how, might have, based on the interpretation of what they heard, might come back with 4, 5, 6 different approaches to do that. So what you're trying to do is that you're endeavoring to discover information you did not know for the purposes of getting to what is the appropriate and final attack. What is appropriate and final outcome or design in this arena? This is the test when most people get hung up because they say, listen, I've been in business doing the same thing for 20 years, Dawson. I don't think there's a lot of risk in what I do. But let's take the engineer scenario. I would push back, let's say it was Robert that said that, and I said, well, okay, Robert, are you telling me then, with the nature of what you do, that you could have anybody in that meeting, you know, a bookkeeper, someone from human resources, or a non-technical salesperson? And obviously the Roberts of the world say, no, Dawson. You know, they need to have some semblance of knowledge of what it is that we do, okay? So that's where your risk resides, that uncertainty. You can't just have anybody focusing on that new product and or new process, improvement to the process, et cetera. So that's the technical risk, okay? Endeavoring to discover something you did not know before you started the endeavor. Test 3, and this really is the big test. It really kind of encapsulates the congressional intent, why it exists. And it says the taxpayer, again, you and your people, need to be relying on the principles of a physical science in that new product or process or improvement to that process, okay? So we're talking about the sciences, the biosciences, engineering, physics, computer science, i.e. software, okay? As opposed to those things that are more behavioral in nature, taste and feel and touch and aesthetics, okay? The hard sciences, these are the jobs, the know-hows that the federal government wants to grow, sustain, maintain here in the U.S., okay? And I do want to highlight that relying on the principles of does not require these individuals to be formally degreed. They don't have to be certified. They don't have to be licensed, as long as they're relying on the principles. Over the years, and I've been at this for 16 years, I used to do a lot of work in the precision machining space, tool and die makers. Some of the guys in the tool shop barely have a GED, but they're exceptionally crazy intelligent. They're certainly relying on principles of engineering to get those designs out the door. So again, that's the third test, technological in nature. Okay, final test. Okay, it's called the process of experimentation. Okay, and it says the taxpayer needs to be evaluating one or more alternatives in an effort to address the design uncertainty, the technical risk uncertainty test you had in the part 2. Okay, and in all the years I've been at this, there are really 3 major fact patterns for highlighting the getting over the hurdle of this test. The first one, we all know it, the scientific method, right? You have a hypothesis, you have a control group, you introduce a variable and you measure the outcome. Introduce another variable, measure the outcome, and you document it, okay? Probably more formal than a lot of people on the broadcast today. The other 2, however, you certainly are engaging in. One is we just simply call it the evolution of the design, starting out from concept through final delivery, okay? And it doesn't always work that way in the real world. You never go A to Z. It's always A to C to A to B to then maybe potentially to C, okay? For some of the designers that might be out there, it might be in those pre-design phases, design development phases, schematic design, okay? That's where the glut of the R&D is happening that passed those 4 tests, okay? And then the third, and my favorite, we all know it. It is a tried and true process of experimentation. It's simply trial and error. Looking at, listening to what needs to be accomplished, rolling up your sleeves and getting it out the door, okay? If I were to sum up these 4 slides, certainly you guys don't think through the optic of tax, but if I was training in your driving education and awareness within your office today, I would simply ask you 2 questions. Number 1, did you do anything today that was neck up work, right? Use your head, designing, drafting, conceiving, contemplating uncertainties, resolving uncertainties, all those INGs. And did you do any of those things in an effort to make something better, new or improved, back to the first test? Because if you raised your hand or said yes, there's a good chance that your people on a fairly systemic basis are satisfying the 4 tests that I just quickly stepped through, okay? Hope that makes sense. And we can move forward, Robert. Just to give an idea, and again, if you recall, it's industry agnostic, okay? So I'm highlighting manufacturing here, and this is certainly not an exhaustive list in manufacturing, but it's really open to, again, all industries. And if you were to ever ask me the question, Dawson, what about this activity? What about that activity? I would always work with you. We would go through that gauntlet of those 4 tests. Okay, so for example, let's say, Dawson, we're looking at reducing labor costs. Okay, would that be a qualifying activity? Well, let's go through the 4-part test. Number 1, what's new or improved? What are you looking at how are you reducing it? What are you attempting to do? You're not doing it for the fun of it, right? And then second test, uncertainty. What's the uncertainty? What are you endeavoring to discover that you did not know before the start of the process? And think about the wage expense, the wage of trying to figure this out. This is where your credit is being driven, okay? And then technological in nature. What principles are you relying on in engineering relative to reducing labor costs? So it might be a software. It might be some sort of equipment, okay? So you get the idea that that's how you would run through and answer that question. Depending on what industry you're in, you can certainly reach out to Stacy, reach out to me, and we've got 1 sheet and we can talk through just unique and distinct facts to your business. Okay, just a quick question, Robert. How fast did I do that? How long did it take me?
You did great. You're one of the best co-presenters I've seen. You're at 21 minutes.
Okay, good.
Yeah, no, I am very impressed. I sent Stacy a request to unmute. Stacy, can you hear me?
I can hear you.
Wow, good job by your co-presenter Dawson to give you some time to speak.
Yes, Dawson, thank you. I appreciate that. And thank you for the introduction, Robert. I'm not sure what theater picture you may have found, but
I think it's another. Yeah, you would have clearly been in this production. So I think I found another Stacy Goodman. So I'm glad I didn't show the picture.
Thank you. Well, I am the only one that spells my name with an E. So if it's spelled any other way, it is definitely not me. But everything else you mentioned was absolutely correct. So thank you for that introduction. So as Robert mentioned, I Was in the Coast Guard as a diesel mechanic and marine safety officer after 9/11, and then went into construction management at Georgia Southern. And wow, that was an extremely fun school to be at. It's a very good program with a lot of kind of boots on the ground, practical experience through that education. So that was a wonderful experience. And then in construction industry, and then into accounting, which wasn't a necessarily easy bridge to know that existed, but it was able to really utilize my background with construction and learning the accounting laws to see how it all flows together. So if we can move on to the next slide.
I'm going to hit Dawson up with some questions first before
Okay.
transition. This is a good time to break for the R&D related questions that I've received. So Dawson, in no particular order, here's some questions I've pulled from the chat box. Question number one, any risk for this tax credit to be repealed or expanded under the new administration?
Oh gosh, I don't have a crystal ball, and certainly there's always a chance, as divisive as Congress is. But the way I would caveat it this way: the credit's been around since 1981. It was always renewed 15 to 16 times. Next to maybe Big Pharma, it's probably one of the top lobbying efforts, or it's certainly top 5, because it is such a powerful incentive. So my gut tells me, and again, knock on wood, that I don't believe that it's going to be in jeopardy. It really is helping drive innovation, because when Reagan first brought it in, we were the very first country that did it. Fast forward now 35, 40 some years, we're now ranked 26th globally, meaning there are other countries offering more lucrative incentives similar to R&D for the sole purpose of motivating business owners, their workforce off our shores and onto theirs. So I don't see it going away, but again, I don't have a crystal ball. Good question.
Number 2 is any good examples of what doesn't qualify? What's an example of where you go through the 4-part test and it's a big no?
Oh gosh, it's really going to come down to that third test, that technological in nature test. Are you working in the physical sciences? Because some people will think, okay, a financial services firm, a CPA firm, they're not going to qualify. But if they're leveraging technology, let's say they're coding some software, they're getting into computer science. So the distinct and way thing to look at this is if it's all about behavioral anthropology, taste, feel, touch, aesthetic, it's going to throw it out immediately. So I would focus there. It'd be similar to this. I'd get the question, Dawson, we're trying to get better internal communication, better efficiencies internally, and we had everybody read the book, Who Moved My Cheese? Again, great book if you've never read it, but that's going to be more behavioral in aspect. So I don't know if that specifically answers the question, but again, focus on that third test, technological in nature test, because that's what's driving this thing.
Are there any emerging hot button issues with the IRS around this credit, or best practices for defense of the credit?
It's always, well, I shouldn't say it's always been. Like all things that happen with new legislation, private industry gets out in front of it, right? So in 2 to 3 years after people have taken advantage of it, the enforcers, the IRS comes back and says, hey, hold the horse here. Well, we had that with the R&D credit when it was changed in 2003 and really opened it up to the small mid-sized practice. It was what was called a tier 1 audit issue, meaning that all returns were reviewed, were audited. But Schulman was in at the time. They looked at this. It was in the tier 1 status for 4 to 5 years. I think it was up to year 2014. They did not find what they thought they would find and then removed that placard. So we do not see a lot of audits. In fact, nationally speaking, it's less than 2%. So there's no glaringly apparent thing that you look at the R&D credit, because again, it is permanently codified now, so it's not snake oil like it was kind of looked at before. But you should be confident in that if you have documentation. What the IRS is looking for is, okay, great, Robert, how did you qualify it? How did you qualify that activity by the 4-part test? And where's the connection to the wage base? So that's where time record data comes into play, time sheets, those types of things. But if you've never taken advantage of the credit before, you get a pass in that you weren't aware of the level of documentation that you needed. So I guess what I'm saying is you should take advantage of it, even though you may feel you don't have documentation today. You will learn what you need, and it's not that high of a hurdle.
2 more questions from the chat box. One is, can it be for internal use projects, or does it have to be for customers' projects?
That's a great question. So there's a 4-part test, but when you start looking at what's called internal use software, there's additional 2, right? Are you developing it for outside facing to your client base, interacting with your client base? I don't want to get too much in the brass tacks, but if it is software related where you're looking at taking advantage of the credit, there are 2 more tests, and I can get more detailed on that with some slides. But there is some nuance if you're leveraging or looking at taking the R&D credit with internal use software.
And then last question for now around this is, is there any other credits that you might be taking that would mean you can't pursue this tax credit, or any other tax-related situations that minimize the ability to use these tax credits?
I'll say no with an asterisk. So number 1, it's a general business credit. So it's not, if you take advantage of another general business credit, you can't take advantage of this. So no, there is no limitation there. There is some limitation on partially owned ESOPs. There is some limitation if you are over, on average, gross receipts over 50 million, and you are an S corp. There's some limitations provided that come into play by what's called alternative minimum tax, AMT. But for the most part, there are no limitations. It really just comes down to facts and circumstances. There's no limitation on size of credit you can generate. It's really driven by, gross receipts, W-2 expense. Those are the 2 major things you're looking at.
Cool. All right. Well, I'm going to hold the rest of the R&D tax credit related stuff. If we have time, I'll hit you up with a couple more at the end. Dawson, I'm going to mute you and and I'm going to mute myself. And Stacy, you're going to have the mic.
All right. Well, thank you everyone for having us here. So let's jump right into the energy side of tax credits and deductions. So right now we've got 2 out there, the 45L and 179D. While they both are concerned with energy efficiency, they are both very 2 different tax saving tools. The 45L home energy tax credit is a $2,000 credit per dwelling unit and applies to both single family, multifamily, student housing, lots of different things. There's a few tests that you want to get into that. But you also, it has to be 3 stories or less. And it is somewhat very difficult to qualify for. If you are in California, their building code and standards are much higher than the rest of us. So there's opportunity to get it. It can be very significant. It was extended. It was slated to expire at the end of 2020. It was extended in the recent bill through 2021. So the 179D commercial building deduction is a totally different animal and is related to commercial building, which then again can account for apartment complexes that are above 3 stories and above. So if you don't have that 45L credit, if you have a 4-story building, the 179D would qualify for that. And that's up to right now at $1.80 per square foot in qualifying components. And the big news is became permanent with the recent legislation that came through. There are some caveats to that permanent rule, will be more difficult to qualify for, but we'll kind of get into that in the next slide. So if we can go to the next one. So 45L, this is the tax credit for $2,000 per dwelling unit. So if you have 400 units, that is, and they all qualify, that's $2,000 credit for all 400. This is just 50% below in the baseline model. And you want to go through a certified ResNet rated engineer. It is a pretty extensive process. There's a lot of tests that need to be made, and it can be somewhat difficult, but as always, if you have a project that's in a good climate zone, it takes into account the temperature, the annual temperature. If you're living in anything that is real extremes, tends to not qualify, but if you live somewhere more moderate temperature like California, you are in the kind of the zone to do that. I'm sorry, the chat box keeps distracting me. So this is, you want to just kind of work through someone who is certified. That's not something that you can do on your own or have your in-house. If you've got engineers in there, they need to have a certification to be able, in specific software. We'll go on to the next slide. So for 179D, this one is definitely more appropriate. We see a lot more of this going through because the baseline for so many years, since the last 10 years, has been based on 2007 energy standards. So that was way, building code basically today met the qualifications to get the 50% energy savings. The problem was no one knew if it was ever going to be renewed. It was a continually extended 1-2 years since it was first created. So this one looks at three building systems in a building. It looks at your HVAC, your building envelope, and your lighting. And it can take a factor of 1, 2, or all three, so you can get up to $1.80. There's a lot of different ways, but the big thing with this is our designers of government buildings have the ability to utilize this deduction. That's where we see a lot of work come through with this because the government building has no need to do this, to use a tax deduction. So the designers, getting a little, okay, so now we have, let's move on to the next slide. Okay, so what's the big thing that I wanted to make sure that everyone knew about going forward, because it's been around for a while, with the enactment of this being made permanent in 2020, the two big things that it changed is there's an inflation adjustment. So that will be determined based on the current tax year that you are in, will be adjusted with the inflation table per the IRS from the $1.80. So the good news is the deduction is going up. The bad news is the reference standard has been changed to be within more recent. So it will be within 2 years of the ASHRAE, of the latest ASHRAE standard from when your property begins. So if your property takes 2 years to build and a standard had come out, you want to kind of go with the standard from when you started than from when you finished, because we all know as everything gets longer in life, they tend to get a little more stricter, and the same thing goes with building codes. So that's the two big things to know. I mean, it's really exciting that this was made permanent, and planning and appropriate planning can now take place, but now you have to really, this is really incentivizing owners and agencies to build green, because if they're not specifically looking at building green going forward, then they would not be meeting the 50% threshold to be eligible for the energy deduction. And so we can move on. And so the different deduction types, I've kind of mentioned this a little bit earlier. You've got the three components that the IRS looks at, and so you can do qualify for all three, or you can do a mixture of all three of them, or one of them, or two of them. So there's a lot of ways to be eligible for it. So it's definitely something that you want to look at, whether you're doing a renovation or a new build construction project. This is something that can be depending on the amount of square footage, this can be pretty significant savings. But you want, if you're doing even if you do a relighting project, you want to look at to make sure that you've met the threshold to get the 60-cent deduction. And with lighting, there's another special rule under the lighting side, where even if you don't meet that threshold for the full 60 cents, you can still get a prorated kind of step down amount depending on where you fall in the calculation for energy efficiency. So there's many possibilities with this deduction. It's always worth it to have someone look at it. Okay, so let's move on to the next. And so the government-owned buildings, what I had talked about before, this is for anyone that designed a government-owned entity. This is not included in nonprofit buildings, but for right now, we're looking at government. So schools, prisons, military bases, airports, anything like that. If you had any part in the design This can be a lot of dollars out there, especially when you're looking at these really large scale properties to where people will really fight over them. So the biggest thing to know if you are involved in a government building project, you want to make sure you've got the signed allocation letter and you've worked that out. There can be a lot of push and pull between architect, GC, engineers as to who is going to get it, and it is a first come, first serve. Whoever gets the form signed first wins. So this is an issue that I've seen continually over the years with no one realized the GC took the deduction and didn't tell anybody. So it's something you want to make sure that you are educated on if you are in that industry working in this. So this is next slide. And so that's it for the question, the energy side. That was a lot of information. So Robert, do we have any questions?
Well, you made me chuckle when you said, and the GC took the credit. That's hilarious. I love that. Sounds like every general contractor I've ever worked with. So yeah. No disrespect to any general contractors on the call. Stacy, I have a couple questions, and some of these are just mine because I'm not very knowledgeable about these, and then a couple from the box. So, first question with the 45L, the home energy efficient deduction, if you have 5 rental houses and you do the same thing to all of them, can you take that $2,000 deduction times all 5? Or is it, I couldn't follow the math. Is the $2,000 available to each one of the dwellings or just one per year?
To each dwelling unit. So yes, so if you built or significantly renovated all 5 units, and you would get $2,000 per unit.
And it does like an air conditioner or roof or solar. What's an example of something commonly used to take advantage of the 45L?
The 45L is pretty significant in how and extensive in what you want to qualify, how to qualify for. So they're looking at the air conditioning unit, the Sears rating. They're looking at the envelope of the building, how much heat transfer, how much air duct, a duct blower test in the door. They're looking at electrical usage, and so everything is kind of taking all of those numbers of what you install and comparing it to the baseline of I can't.
Is the amount
that. So it really, it's not if you do just kind of a small renovation, you would need to do the windows, you would need to do everything basically.
And then a couple questions around the 179D, the commercial one is the percentages that you discussed in the presentation, are they a function like X% of the improvement in utilities or X% of the cost of the upgrade?
It's the well, I'm not sure I'm not sure which one you're referring to on that.
Like if you were to upgrade, you were to make a significant lighting upgrade in a warehouse, and I'm trying to get a sense of is the potential 179 deduction, is that you might save, you might be able to take as a credit a certain percentage of the cost of the lighting upgrade, or you take a certain percent of the improvement, utilities improvement to calculate?
It's based on the square footage. So how this works is an engineer there's a software you put in the data for what equipment you installed for your light fixtures, how many are in there, what size of the space is in, and where the building is located, which way the sun faces, and it puts that into the software and does a calculation to show if so it takes in all those environmental factors to say whether or not you meet that threshold of being 50% more efficient than the baseline that's being measured against. And if you meet that threshold, then you're going to get the full 60 cents for the example of lighting you'd get that full 60 cents. And then that 60 cents is multiplied against the amount of square footage that the renovation took place in. So you are limited to, if you had a higher deduction than you spent, you're limited to the amount of what you actually spent. But usually that doesn't typically run into an issue unless it was just a lighting project. But if you're looking at a full scale, you are limited to what was actually spent, but it is based on if you meet the threshold of being 50% more efficient, and then it is the square footage of the qualifying area multiplied by the $30, $60, $80.
One more question from the chat box, and then I'll hold the rest till your next stop. It's once you get the credit, is it automatically there for each year, or is there a requalification process that's necessary each year?
This is a one and done.
Okay.
Yeah.
Okay. Cool. Well, I'll hold the questions, Stacy, till the next break.
Okay. So now we'll go into the cost segregation side of the house. And so this is focusing on depreciation for your capital project, or your capital improvements that are on the tax return. And so I wanted to kind of not insult anyone's intelligence, but go through some real basics of what depreciation is. And so this is, you want to, depreciation works with, we've got the 4 steps right there. So you add your revenue, subtract your expenses, report that difference, and then that multiply the taxable income by the tax rate to calculate that total amount. So if we can head on to the next slide. And so really kind of focusing on that second step, well, your, that seems a little, we're stretching these deductions out over time. And by taking that, you're not breaking down your depreciation in a cost segregation. So you're stretching these deductions out, you're able to, sorry, child is running around the house. You're increasing your tax burden. So I just, okay. So you're taking, let's go to the next slide because I'm not sure. Okay, so here, let's kind of break this down. Your asset classes, which is what your cost segregation study is breaking down these into multiple different buckets. And so not all assets are created equal in a sense to where you will, depending on your industry, everything is based on the industry that you're in and how you use your building and what it's being used for. So items that are used in a dealership, the lighting may not be the same as treated as what is used in an office building. So it all depends on what the business is being used for as far as which bucket it will fall into to be depreciated. So let's go on to the next slide. And so now we've got a couple of there's a lot of topics to talk through in cost segregation. And the big one is qualified improvement property. A lot going on with this. This had a few different names in the years past. It was qualified leasehold improvements. It was qualified restaurant improvement property. And so that all got changed in the TCGA Act a couple years ago. And then in that act, they forgot to add a word and did not change those leasehold improvements, these qualified improvements, into 15-year. The CARES Act early in the year corrected that 15-year mistake. And so that has now opened up a lot of items that was built in 2017, 2018 that was not eligible to take that 15-year qualified improvement property and is now eligible to do that, to go back and recapture that missed opportunity. So qualified improvement property is a couple of rules that we need to, so it's not eligible to take a bonus, but it is, you can retroact, go back and take it. There's multiple options to adjust for your previously filed. This is an improvement to an interior portion of a building which is non-residential. So any apartments, assisted living, Airbnb, that would not be eligible for qualified improvement. So it's taking these essentially what it does is it takes these items that were 39 year, always going to be 39 year unless it met very specific rules. It allows them to be 15 year. So as long as it's not enlargement of the building, elevators, or internal structural framework. But staircases do count, if you're moving walls. So there's a lot of things that would traditionally just stay in that 39-year bucket. And now you can move into 15-year if you meet all the kind of qualifications. So that's something to be aware of as you kind of think about where you're at and your building and what you've done in the past couple of years. If there were any major renovations, there may be some great opportunity to reduce that taxable basis. So let's go on to the next slide. And so bonus depreciation, this is, I've been around. So right now we are in 100%. So this is just a quick little chart on all the different bonus percentages out there over the years and going forward. The CARES Act had adjusted that to go into 2026. So we know our step down of bonus. So right now we've got a couple more years left of 100% bonus. And so what this is allowing you to do is taking anything that has a life that's been assigned a life less than 20 years. You can take the 100% bonus right now. So you can take all of those amounts and write that off the basis. So it's very lucrative to use bonus, helps really accelerate some depreciation. And we'll move on to the next slide. And so there's also the NOLs. A lot of changes have gone on with what you're able to do with these. So you've got they have been eliminated. The 2-year carryback from TCJA. The CARES Act allows to go forward. So there's a lot more we can do with net operating losses that have had a lot of recent changes, and just good to have information on that. And we'll move on to the next slide. And we are at the end. Any questions?
Yeah, that was awesome. First of all, I'm just impressed. I'd like to say that the two of you covered what would normally be like a 4-hour CPE session. So that was really well done. And so kudos. And I have some questions in no particular order to the both of yous. So I've unmuted Dawson in addition to Stacy. The first, I'm going to back up. This slide makes me laugh that the bonus depreciation rates change all the time. This is one of those Guaranteed Employment Act sort of charts where CPAs and accountants are guaranteed employment because of crazy charts like this. So God bless our representatives that pass or the lobby. If the CPA, if AICPA is responsible for this, God bless them. And I love explaining to my kids how the GAAP accounting and tax accounting are like, I'm required by law to run 2 sets of books. So I love this stuff. Question number 1, this one I'll back up for you, Dawson, first, is from the chat box. Question around the R&D tax credit is, are you to take the tax credit in the year the project is completed, or along the way each year if it's a multi-year project?
So it's going to be the year, if you remember, it's predicated upon wage expense. So it's the year that the W-2 expense was exhausted, if you will. So it's not so much focused on it is focused on the project, but it's the year the expense happened. Okay. So, but you can, like I said, you can retroactive. So if it was, it's now 2021 and you wanted to look back to 17, you can pick up those credits that would come back in the form of a refund, but it would be based on the state of the world, the W-2 expenses in that year 2017. I hope that answers the question. Yeah. Some of the placed in service or when the project initiated is probably more in line with 179D and cost seg, not R&D. It's really when the W-2 expense happened.
Stacy, next question is around a slide with the 179D. You were talking about how, in a particular funny example, the general contractor had taken the credit unbeknownst to the rest of the team. Any recommendations for paperwork or getting in writing around who's going to be able to take the benefit of the 179D credit? Any recommendations on that document or documents?
We do have guidance, and there is a very specific an allocation form that you want. But I think the recommendation I give people is really your pre-construction team really needs to have the education around this, and that it cannot be in your government contract, meaning that the government cannot request that your fee is going to be reduced because you might be eligible for this. So it cannot have any contractual language like that. But you do want to make sure your pre-construction team is knowledgeable and knows to bring this up and negotiate that ahead of time with the parties that are involved in any type of design work. Because it's a lot of dollars that go on the table at the end of the day, and if it's not talked about, and so that is
Very interesting. This is a question from me around these energy credits. Do you know if any of these can be traded or assigned? And if you can't use them for whatever reason, can you trade or assign these energy credits in some sort of marketplace?
I know you can carry forward, but I do not believe you can do that. I may be wrong on that. So Mike, I may need Mike to answer that one. He's the official CPA.
He's muted, so we'll just go we'll go with maybe. Or no.
I could opine. Hey, Robert, if you let me opine on that too, because we do get the question on the R&D credit. The federal level, there's not going to be, but certain states will have a market for it. For example, Pennsylvania, like the movie tax credits that they used to have, you'll have some ability to market those state credits. Because again, it is primarily a federal incentive on the R&D credit, but there are 37 states that if you match or meet the requirements at the Fed, you'll also get the benefit of R&D credit at the state level. Won't be as robust as the federal, but it is there on the state too. South Carolina being one of them.
Okay. Dawson, question from the box is, what happens to accumulated but unused R&D tax credits when a company is acquired? Is there a limitation on the amount of those credits that will transfer to the acquirer?
A couple things. So if you are a pass-through entity, the credit is aggregated at the entity, but the benefit flows through to the individual shareholder based on their apportionment of ownership. So it's always going to reside on the 1040. So even if the business is sold, the beneficiary is going to stay with the shareholder. Okay? On the C Corp, it's going to really come down to whether it's an asset purchase, a stock purchase, but typically it's going to stay with the entity. Okay? Because it's not flowing through to an individual. So hopefully that answers the question.
Yeah. Well, that was awesome. I have a bunch more questions. We are near time, so I'm going to have to hold. But what I will do is I will send out a copy of the full deck. Dawson and Stacy did an awesome job getting through this material because they have like half the presentation hidden. So there'll be a PDF version of this, a more full deck, and I'll also provide contact information for Dawson and Stacy for any follow-up questions. There was a lot of content to share. And if you have any follow-up questions, I'll be able to provide that contact information for them. And just thank you very much to Stacy and to Dawson and the entire CTA team. You guys have been a pleasure to work with. And I personally really enjoyed this presentation. This is the perfect time to be thinking about these type of opportunities for the new year. So great, timely information. And CTA came recommended to me. I'm actually... as the CFO of Lifecycle Engineering, we are considering pursuing R&D tax credit. So via the CFO Council, a member has used CTA, really recommends them highly. So you don't have to go at this alone. I'd actually recommend getting a partner. And if you're going to get a couple people to quote any of these types of tax credits to pursue and document the justification, I recommend CTA being one of those to have a quiet conversation with. You guys did a great job in the presentation and a great job for partnering to pursue these tax credits. And to close, as always, folks, like, comment, and share my post on LinkedIn. It's super easy, and I'll know you did it because LinkedIn tells me that you did it. And you too could be a prestigious spread the word winner. There's really no greater achievement in life as a senior financial executive than to be the spread the word winner of the Global CFO Council, like Joe Moore, Vice President of Finance at ScanSource. So be like Joe and like, comment, and share my content on LinkedIn. Thank you to the entire CTA team, and thank you to the CFO Council. Everybody have an awesome day. Bye-bye.
Likewise. Thanks, everybody.
Bye. Thank you, everyone.